Welcome and thank you for tuning in. You're listening to the Beyond 50 radio program. I'm Daniel Davis. Here we are in the holiday season with many of us planning on what we can do with our money when it comes to bearing gifts for families, friends, loved ones, and even ourselves. Trying to find those great deals from Black Friday and, of course, the day after Christmas when some of the greatest sales are happening. What I find funny about this particular act is that most people will spend a lot of time trying to find the best bargain for their money to spend. That way they can save, so they say. But saving is the tricky part, especially for Americans. Many of us try to find the right way that we can plan for our retirement, if that's what we decide we want to do, by going out there and finding out the best ways to invest our money. Most of the time what we do, though, is we just turn it over to hired experts who allegedly point us in the right direction. But not understanding how your own money works and how investment works for the most part can be not only tricky but a very costly business. On the program today, we're going to be talking with someone who has more than 40 years of financial experience. He's also the host of his own radio show, which is Investing Simplified, which you can hear on Freedom AM 970. And he also has his own financial wealth management group, which is located in Portland, Oregon. I'd like to welcome to the Beyond 50 radio program today our guest who's going to be talking with us about the 10 biggest misconceptions and myths of investing so that you, the listener, can become better educated. His book is Investing Simplified, What You Don't Know Can Hurt You. And I'd like to welcome Chuck Price to the Beyond 50 radio program. Chuck, how are you?
Great, Dan, and thanks for inviting me on the show.
You betcha. Now, what do you typically experience when somebody walks through your door? Do they have like that wide-eyed look, like I really want to put my money somewhere and I want to trust that it's going to have the right thing happen, but I just really don't know what's going on here?
Well, Dan, basically when people come into us, they fall into one of two categories. Either they've done nothing and they realize they have to put something together and do something, or the other part is they come in and they've been working with some advisors and they just have in their gut feeling that something isn't right, and they look to get a second opinion, which I always highly recommend a second opinion because a second opinion never hurts on anything.
Mm-hmm. Now, let's go ahead. It's interesting because I remember some time ago, and you hear this or see this on the news sometimes, there's the little old lady who got swindled out of everything she ever saved from somebody who was a real shyster. And it's funny when you really look deeper into that because the thing is, nobody held a gun to her head. She picked up a pen and she's probably signed a contract, and she did this willingly, and most likely this person told her things she really wanted to hear, like these great rates of return, and we've all heard about these sort of a thing, and then in the end you realize, well, maybe you were just greedy and you just didn't make a very good educated decision.
Well, you really hit the nail on the head there, because there are a lot of people who come in who were sold very high commissioned annuity products, come in and their money's tied up for 10, 12 years, and they were told they were going to make all this % of income, and when you analyze it, they're lucky if they make about 3.5% to 4% on their money, and normally it's tied up. And a lot of times they heard what they wanted to hear, and that was that you could never lose your money's not going to go down, and you're going to make a reasonable return. But the real question is, what is a reasonable rate of return, and what is the risk that you're really bearing when you tie your money up for 10 years?
Mm-hmm. Now, here's the thing, too. You talk about risk, and it's fascinating because if you really begin to do your homework, you realize really good investment strategy has to do with managing risk, correct?
It's all about risk.
Okay.
Exactly.
Now, tell us how we should approach that.
Well, I think when you sit down and you talk to an advisor about risk, you should be honest with yourself, because if you're going to get upset when you look at your quarterly statement and your portfolio went down 10%, think how upset you're going to be if at the end of the year you're down 40. I mean, that's the risk.
Right.
And if you think you can buy an investment that's never going to have fluctuation, you are not buying an investment. All investments, that's what the word means. You're taking a risk.
Mm-hmm.
You're investing your money, and you're going to have ups and downs. The key is you need to be convinced that the strategy that you're going into, and you need to ride through the strategy if you invest in a strategy. Now, we don't accept any managed accounts that we work with money managers unless they have a minimum of 10 years experience.
Mm-hmm.
They also have returned at least a net return of 7% or higher to their clients, and they have avoided major risk in the market. In other words, losing a large amount of money in a short period of time and then trying to recover. We just don't want our clients having to go 4.5 to 5 years like the average investor's done the last 2 times we've had corrections in the market, having to take 4.5 to 5 years to recover. We don't want our clients to go through that.
Mm-hmm. Now, before we get into the 10 myths here, it's interesting because some time ago I read it was actually the biography of Warren Buffett, very well written, and it was one that was actually blessed by him. In other words, he says, I love the way you write. She was in financial strategy and insurance for years, and he must have enjoyed the way she wrote because he says, I'm going to give you unprecedented access to my life and all the lives of others to help formulate my story. And as you read this, it begins to emerge that investing doesn't seem to be as complicated as what you would be led to believe out there. Now, that doesn't mean that there isn't work and homework involved. There is that element of it. But when you begin to read the story and the approach to it, you realize, my goodness, it's not really as complicated as you think it is.
It's not really rocket science. You're right. It's really not. And people need to take a little bit of time. And I tell everybody, listen, if somebody's telling you something that is too good to be true, it probably is.
Mm-hmm.
And, it's like you mentioned at the start about people maybe being naive about when they're investing. It's kind of like all the people that Bernie Madoff, we call him Bernie Madoff with your money. Bernie Madoff, he appealed to people's greed. That's what he sold. He sold getting high 20 to 30% returns that any logical person would have looked at that and said, wait a minute, where on earth are you getting these numbers? And people just thought, hey, I'm going to give him my money. There's no risk on my money. He's going to make me 20, 30%. That's not realistic.
Mm-hmm.
That's total fantasy. And people who get the greed thing going for them are just going to have a train wreck.
Mm-hmm. I remember I was listening to, I believe it was the book, The Millionaire Next Door, and there was a story about a guy who had a financial money manager approach him talking about this great rate of return as you're describing here. And he says, well, this all sounds good. This was someone who had quite a bit of wealth that he had built. The book is based on, that millionaire next door is this quiet, meticulous guy that just goes about his day. It isn't the sexy Hollywood thing that most people seem to believe is true. But anyway, so he says, well, that sounds like a pretty good rate of return, so I'll tell you what. Why don't you go ahead and show me your W-2s that show that you're in this investment vehicle and what kind of returns you've had over the last 5 years. And if they meet what you're telling me, then you get my money. And the guy says, well, we're not allowed to do that. And he says, well, then you're not allowed to have my money. And I thought, boy, that's a great way to screen that out.
Yeah, but here's the thing, Dan. You got to understand that the securities industry is regulated
mm-hmm.
by regulators who set guidelines and rules that if you violate, you will be fined
mm-hmm.
thousands of dollars, and one of them is doing something like that. And so from a regulation standpoint, you can't go showing that because, and I don't understand why the regulators have it, but that's what they have. And that's why you don't hear, it's just like you can't pay somebody to endorse you. The Securities Exchange Commission and the Registered Investment Advisors, the state regulators, totally frown on you getting somebody to personally endorse you. Say you hire somebody like an actor to endorse you that you invested their money and you made them millions of dollars. Well, if you do that, you will get fined and maybe even go to jail.
Mm-hmm.
So you got to be really, really careful with the regulations. But anybody on any investment can show anybody the verified, accredited result and return of the investment you're going in, and those have to be actually validated and accurate. And if they're not, you can be fined and go to jail.
Okay.
So regulations of securities are very, very strict for people misrepresenting what they're showing. And unfortunately, there are a lot of people every year that do get fined, and that's one of the things I mentioned in my book. One of the first things you should do if you're working with a financial advisor, you need to check them out on broker check.
Okay.
You need to check them out and see, have they had any complaints on their record? Have they been fined for doing this? You need to also check with the state insurance department and see if they have been fined, if they have been charged with doing misrepresentation, if they had to pay a fee. Unfortunately, the states and the feds, even though they fine people, they still allow them to do work. It's just like there are a fair amount of financial planners who have actually went through personal bankruptcy. They should disclose that right up front, but a lot of them don't. Now, all ethical standards say you should disclose that right up front to the client. And I tell in my book, one of the things you should do when you're interviewing a financial advisor, you're hiring them. They're not hiring you.
Right.
They're going to work for you. You need to ask them those questions. Have you ever had a complaint? Have you had something filed against you by the feds or by the state regulators? You need to ask that question. Have you ever filed bankruptcy? Have you had financial difficulties? If the guy's handling your money, shouldn't you be able to ask that question?
I would agree. Yeah, sure.
Yeah, and most people don't. It's just like there's a very large number of CPAs in this country that have filed bankruptcy. Unless you directly ask them, they don't have to disclose that to you. But if that guy's going to handle your money and handle your taxes, don't you want to know? Don't you want to know they handle their own money pretty well?
Mm-hmm. Yeah, and that's such a great point to point out, because a lot of times we go blindly, and it's like going to the doctor, to find out, there's this ailment, I don't know, it's been coming on, it's been in this area, you know your body better than your doctor does, but it's through the information you give them that they try to make the best decision for the outcome. And this relationship here with a financial planner shouldn't be any different than that.
Absolutely.
Mm-hmm.
Absolutely. And you got to be directly honest with your financial advisor and tell them what you have, because just like a doctor, if your financial advisor doesn't know where your assets are invested and what you're doing and what your long-range plan and goal is, just like the doctor who says, I got to know the medications you're on, because if I could prescribe the wrong medication, I could kill you.
Mm-hmm.
Well, they could ruin your financial plan if they overweighted you too much in one area without knowing your entire situation. So you have to have a mutual respect of honesty, just like you have with your doctor. You got to have the same thing with your financial person.
Now, here's something, because you have such long experience in this arena of financial investing, how often do you find that potential clients come in and that element of greed really surfaces? And the reason I ask this question is this. You had mentioned earlier that generally when a financial planner talks to you about a particular, let's say, investment strategy, and let me just use an example, Enron could be an example. It's not a great example, but it's an example. But you talked earlier about variables, that they have to disclose accurate variables in the investment. Now, when I heard that, I started thinking, because I've seen this happen once or twice as I was out there, finding ways to invest my own money, and they would show, well, look at the rate of return this particular investment had this year was about 40%. Okay, so that's a true variable, that maybe that year that investment really paid out a return like that. That's the one that generally sticks in the person's mind, and for some reason they slip into fantasy land and they don't hear anything else this planner is talking to them about, and they believe that somehow through their own will and maybe an act of God, they're going to see 40% rate of return every year if they decide to go with that vehicle. Do you see that sort of thing, that deer in the headlights sort of a situation?
I hate to tell you this, but I do. I see it, and what I always tell people is this: look, when I sit down with people and I'm showing them a particular investment. First of all, any investment I'm showing you is going to have at least a minimum of a 10-year track record.
Right.
If that investment is less than 10 years, you are the guinea pig investing in it. Don't be that person, okay? Don't be the person that's going to take the leap of faith and say, oh, man, this is the greatest investment since hotcakes to lumberjacks. It doesn't work that way. You want to see a tried and true investment. You want to see how it does in good times and how it does in bad times. And I always tell people, look, if you're looking at an investment, the first question I would ask is, what is the best year you ever had and what is the worst?
Mm-hmm.
Because I'll give you a good example. I had a person come in the office, and they were just all excited because they had bought this investment from an advisor, and the last 5 years this investment had made 15% a year. And they were just, they just said, man, this is the greatest thing, and you can't show me, I don't even know why they came in, because I said, well, if you're so happy with this, then maybe you ought to stay with it. But I said, did you really look at the 10-year track record of this investment? Well, no, we just looked at the last 5 years because our advisor said, this thing has really taken off. This is a great investment. Well, the entire market's been taken off since 2009. Mm-hmm. So I went back and looked at the 10-year results on this investment. It was a 3% per year return.
My goodness.
Because, remember, we had that crash, and at one time the crash in 2000 through 7 and 8 and into 9, at one time the market was down 90%. Mm-hmm. And so we went back and I looked at the numbers, and they took out the worst part, and they took it at the very bottom, and that's what they ran the numbers at. But they didn't show that big decline. Well, the fact was that when you ran out the 10-year return, it was the 15% 5-year return became a 3%. Mm-hmm. And I said to the client, I said, do you understand that this investment really, if you want to realistically look at it, I'm telling you this is a 3% investment. And they were mad at me. They were mad at me because I told them the truth. And I said, you need to go back to your advisor. And I printed out the report for them, which I took right off of Yahoo Finance. And anybody can do that and check out any fund they buy. And I recommend it in the book. I talk about this in the book. You've got to be your own researcher. When people are telling you things about investments, you can check them out. You need to check them out. But if somebody's telling you this investment made 15%, that in itself ought to tell you right now there's a problem. Mm-hmm. That's too good to be true. Mm-hmm. So you need to go and you look, and then you find out over 10 years it did 3%. Mm-hmm. Would you really want to tie your money up for a 3% return?
Yeah, that's about what not as good, but what you more or less get in the bank. Just that a basic savings is about 1%, so that doesn't sound too good when you consider inflation and taxes.
Well, not in taking a risk, because remember, that's a 10-year average, but at one time that investment, when you started it, that thing went down and you never recovered for 5 years. Mm-hmm. That 5 years of making 15% was all recovery time. Mm-hmm. So you actually made no money, so your money sat idle for almost 5 years.
Wow.
Yeah, that's when you start thinking about, what I always tell people is look at recovery time of the investment. That's the key. I don't want my money sitting idle, not making any money. That's why it's an investment. If you're not making money on the investment, you're losing money.
Now, would you suggest, too, that people would take a look at beyond 10 years, maybe 15, 20, or even 30 years when they're taking a look at something?
Well, I think you can if companies have long-term track records. We have one, for example, that's been around since 1992, and they've never had a losing year. But I tell clients right up front that doesn't mean they can't have one in the future. Right. They've been very fortunate. They've done extremely well at avoiding the big dips in the market, and that's the strategy. And if people what I find that people do is, well, in fact, Delbar ran a study, and I got it from E-Trade. E-Trade did a study, through Everbank. Everbank did a study. They have EverTrade. EverTrade did a study for 20 years on the Dow Bar, and the average investor over that 20 years actually lost money. And the single biggest reason they lost money is they didn't have a strategy when they were investing. They didn't have a strategy of going into the investment. They didn't have a strategy of coming out of an investment. And when they bought a strategy investment that had strategies to offset the markets up and downs, they didn't have the patience to stick with it. So we always told clients, look, if you're going to invest, you have to invest logically. Get the emotion out of it.
Mm-hmm.
If you fall in love with your wife, don't fall in love with a stock.
Right.
You got to get the emotion out of the investing and look at things logically. And if you logically look at the market, I don't care what investment you're in, you can have up quarters and you can have down quarters. There is no investment that exists that has not had a losing quarter or a losing period of time, a short period of time. That's why it's called an investment. They go up and down. And if you can't take that, you shouldn't be investing.
And a good example of that is Apple. Is one of those really good examples. When Steve Jobs had first left the company, it started going down the toilet. He came back, and it started going back up again, and now that Steve Jobs is completely out of the picture, there's speculation as to what direction Apple's really going to go.
Well, and there's a couple of companies like Apple and Microsoft that even though the leaders aren't there, they still have some of the brightest, most intelligent minds in the industry working for them. Mm-hmm. And they still are going to come up with ideas, and I certainly wouldn't say that Apple is doomed into the future because I think they have a lot of brilliant people and a lot of great innovators that are still part of that team that can maybe carry that on to the future, as I do believe Microsoft has the same thing.
Mm-hmm. And it's also understanding the investments that you're getting into, especially if they're directly related to companies, isn't it?
Oh, absolutely. And that's why I say you have to look at things logically, not emotionally. Mm-hmm. About the only stock I can say that I kind of have a little feeling about that is Starbucks, because if you're an avid Starbucks user and you use Starbucks all the time, you stop there and you buy a latte every day, and you're a Starbucks junkie. Mm-hmm. I think there's a thing wrong with buying that stock, because that's a product that you use every day, and you probably even invite friends to meet you there and to get them hooked on using Starbucks. So if you do that, why shouldn't you enjoy the write-up with it?
Right, exactly. I know an interesting story, actually, back to Warren Buffett, that everybody seems to talk about him as the greatest investment strategist, that there is, but there was actually an opportunity, and he's still basically kind of shunned to this day, but he had the opportunity to invest in Intel.
Yeah.
And they say, look at the millions of dollars Warren Buffett, lost, because he didn't invest in Intel. But the fact is, he, A, doesn't really like to invest in technology, and the second thing is he just didn't understand it. And you're going to tell a guy that was at one time the richest man on planet Earth through investing that he was wrong for missing the boat on Intel?
Well, I subscribe to the University of Washington business class, and they send out, once in a while you get videos from them, and one of the ones I've kept in my office is a video of Warren Buffett and Bill Gates at the University of Washington business class, and one of the questions came up to Warren Buffett if he had ever bought Microsoft. Now understand, Microsoft had been a rocket stock, and he actually looked at Bill Gates and he said, I like Bill, but that stock is too risky for me.
Right.
And I thought that kind of said it all, because that's Warren Buffett. Warren Buffett is a long-term buy and holder, and he doesn't go for the little techie things. Mm-hmm. And even though Microsoft had proven their track record for over 25 years at that time, almost 30 years at that time, oh, it was 30 years at that time, he still wasn't going to buy it, and he still hadn't bought it. And he said, I'm doing Bill and Melinda Gates's trust, but I still am not going to buy the stock.
Yeah, but at least he sold them Berkshire Hathaway.
Well, yeah, that's right, yeah. Yeah.
So I think he was the better of the two salespeople, probably, because of Dale Carnegie.
Yeah, I think so.
Anyway, why don't we go ahead and get into these 10 myths here, because I think these are really interesting, and you had talked about the crash, and we're all familiar with what happened in 07 and 08, but real estate always goes up as one of the first ones, and I'm reminded of a friend of mine who got in and became a real estate agent. And she said the same thing, and she said it as though she was parroting the information. Well, you know, real estate, it's always good to invest in. It always goes up. And it was like, but that's the best you could tell me about it? There's got to be more than that.
Yeah, and it isn't true. I mean, ask anybody who bought a house prior to the collapse or bought it right before the collapse. Many of them are still underwater on the home they bought. So for those people, that certainly isn't true. You know, we still have millions of people out there that have homes that are underwater, that haven't been foreclosed on, and haven't paid any mortgage payments, and the banks are holding on to those, and it's estimated there's somewhere around 12 million of those, and they've not hit the market. When those hit the market, we're going to have a decrease in the price of real estate. Mm-hmm. It's going to be automatic. It's going to happen. And the other thing right now that's happening in this country is young people aren't getting jobs. People with degrees are not able to go out and get a job and get employment. Real unemployment in this country is over 11%. If you calculate it the way they did when Bill Clinton was in office, before they changed it, it would be over 11% right now, unemployment. Mm-hmm. And the problem is it's the highest in the younger people. So that younger group of people coming up, getting those good-paying jobs, they just aren't there. And the other thing that's so disturbing to me is that the average income for the average family has went down every year for the last 6 years. Mm-hmm. And nobody says a thing about it. Mm-hmm. And look, if you don't have income, how do you buy a home?
Right.
You can't buy property. So we have a very serious problem coming down the road because of demographics and because of the fact that the seniors in Japan right now, which we're about 11 years behind on the age graphic, on the demographics. In Japan now, you don't have enough young people with good-paying jobs that can buy homes when people die. Mm-hmm. So they're plowing over a lot of the homes because there's nobody to buy them. Mm-hmm. So where'd that money go? It just disappeared to the estate?
It certainly leaves for an interesting question. We had a financial forecaster, Harry Dent, and I know that you're familiar with him, who talked about falling off that demographic cliff, and he said exactly the same thing you're saying, is this up-and-coming generation just doesn't replace the way it used to. And as a result, it creates this huge chasm, which causes a whole lot of problems.
Well, I'm going to kind of jump forward here a little bit to, number 4 when I talk about Social Security. But one of the bad things in America right now, young people don't have the jobs, and the people who do have jobs are not contributing to their retirement plans and their 401ks. And part of the reason why is the problem the government has with social insecurity. Right now, a young person get a job, they have to pay 6.2% of their salary goes to Social Security. The other 6.2 is matched by their employer. That means 12.4 is going into their Social Security fund, and most people are putting in less than 3% into their retirement plan, 401k. So what's going to happen to retirement needs down the road? It's going to require more and more retirement money to come from Social Security than 401ks because the young people don't have the money to put into it. Mm-hmm. And it's just a double-edged sword.
Mm-hmm. And speaking of the 401k, this one always, to me, didn't seem right because you could see the changing scape of business. It wasn't the old industrial way where somebody would go to a company, it could be Ford, for instance, and they would spend most of their working life here in this company, invest their money into whatever investment vehicle they may have, hence the 401k or the IRA, these company-matched savings, and they'd stick around there, and then eventually they would retire, and there it is. But that just doesn't really exist all that much anymore, does it?
Not unless you work for the government.
Right.
Yeah, they're basically gone. The only people who have really good retirement and pension plans are government employees.
Mm-hmm. So the idea is work for a company with a good pension plan and stay with it until you retire to secure all the income you need. So I guess that's become a myth.
It is definitely a myth. There's no question about it. What they did was basically put the responsibility on the individual investor and took it off the back of their employer.
Now, the mutual funds, this is something you hear a lot of people presenting to people who don't do their homework, because this is one of those that really kind of manages its own risks. Tell us about that.
Well, what I mentioned, number 3 there, is mutual funds are managed portfolios, so buy and hold on to them. The fact is, mutual funds are not an actively managed fund. They are passively managed. What I mean by that is, let's take an example and go back to October of 2007, when the market started going down, and the crash of 2008. When you look at that, you go back to that and look at it, mutual fund companies were not able to go to cash because they have to stay in that passive portfolio that they're in, and they can only move 10% to 20% depending on the fund, but they're regulated by the feds, what they can actually move to cash. So they have to stay fully invested. Even though the market's going down every day and it's dropping like a rock, they have to stay fully invested. Where an active managed portfolio, not a mutual fund, can actually go to cash, and most of them went 100% to cash to avoid that big decline. And that's why it took mutual funds, on an average, 4.5 to 5.5 years to recover from that crash, because they could not move the money. It's passively managed. And I'll tell you, if people out there listening, if they just learn the difference between passive and active, they will make themselves hundreds of thousands of dollars over their lifetime.
There you go. See, you've been given an incentive, listeners, so just keep listening, because this is some great words of wisdom that we need to understand better. And, of course, the golden rule being, do your homework, do your homework, do your homework, correct?
Absolutely. Ask questions.
Now, how about
educated.
Okay. Now, how about this one about annuities? All annuities are bad. What is an annuity, and how true is a statement like this?
Well, I put that in there because you hear guys like Clark Howard and Susie Orman basically blast all annuities, and I'm not in that category that all annuities are bad, because I don't think any one investment is all bad. Mm-hmm. There's a reason why insurance companies work, and there's a reason why they're regulated by the state insurance department. But annuities are designed for a purpose. Annuity has two things that they do. They defer interest, and they provide lifetime income. They are not an investment. Mm-hmm. I mean, and this is where these people are selling them. In fact, in 13 states right now, you cannot say, Colorado just became the 13th state that enacted this. You cannot say an annuity is a safe investment. You cannot say it's a guaranteed investment. Now, in other states like Oregon and Washington, you can say that. Mm-hmm. But in Colorado and 13 other states, you can't say that as a licensed agent, because they put more regulations on it, because they've used scare tactics to seniors that they're going to lose all their money if they don't put their money in this annuity and have the insurance company guarantee it. Mm-hmm. Well, that just isn't the case. Mm-hmm. And you have to look at the facts and know, and not get driven by fear. But annuities that have a guaranteed income benefit, and you're buying that annuity to provide a lifetime income for your life that goes into your managed portfolios with in connection with that makes sense. But to buy an annuity for an investment, it's not an investment. Mm-hmm. And that's where I think people get really, that's why I say not all annuities are bad, but not all annuities are the same either. Mm-hmm. And you need to do your homework on that. And I have people come in that have bought so much annuities. I mean, there are 80-year-old people buying annuities that are 10 years tied up. Now they're 80. Now that's optimistic. They're going to make it to 90. I like the optimism there. But the income benefit grows at 6 or 7% a year, and it doesn't get the max value until you're 90. What are the odds of that person making it to 90?
Mm-hmm. having the energy actually to do something with the money once that time comes.
Yeah, I mean, like you're going to really be looking to get this double income 10 years down the road when you're 90, and who knows what condition you might be in.
Mm-hmm.
I just think they're oversold in that basis, and I think people need to be looking and asking that question. What you should ask the question when you're buying an annuity is, what is the purpose of this annuity, and would you put that in writing? That's what you need to ask the agent. What is the purpose of this annuity, and would you put that in writing?
I can't help but address this because you brought up Susie Orman, but we tend to see these television financial investment shows, and I'm sure there's a slew of them on radio as well. And it's amazing how often a person will take what they see or hear, and they'll apply that as the full knowledge to actually make a decision, especially one when it comes to something as risky as their money. As I was talking about earlier in the program, it's amazing how much a person will do their homework and their due diligence to find that best sale. But when it comes to that best investment, they'll sort of passively take information that sounds reasonable enough to make a decision, and they'll do that. My question is, when you take a look at somebody like a Susie Orman, what are your thoughts on someone like that and the information that she's actually feeding people out there?
Well, the problem is that's the problem. She's feeding people. The key thing to investing is to individualize it to yourself. And here's the best example I can give you. And anybody can go on YouTube and look this up. But Susie Orman takes calls. Now, one of the things I talk about in my annuities and about books is anybody who bought a guaranteed lifetime income since 12/31/99, and the main person on that had a death benefit on that guaranteed income benefit, and they died during the crash, the two crashes we had, they came out way better, 5 times better than the average person that invested in a mutual fund and died during that down market, because they were down anywhere from 40 to 50%, where the annuity people didn't lose a penny. So when you pick a moment in time, I can take any investment. If you give me a moment in time, I can pick the best time and tell you which investment came out best during that moment in time.
Mm-hmm.
But the key is, what did it do over that long period of time? And Susie Orman, there's a YouTube where she gets a phone call and a lady calls in because Susie Orman's bad-mouthing annuities. And annuities are designed for a specific purpose. And that's my whole complaint on annuities, is they should be bought for the right reason. They're sold for a lot of the wrong reasons, mainly high commissions for the agent. That's the fact. They should be bought for the reason that they help the client to meet a financial goal. But Susie Orman had a lady call in, and she said, Susie, you said all annuities are bad. And my husband and I bought a lifetime annuity income benefit right before the crash, and my husband died. And Susie said, oh, you poor woman, you must have been devastated when you lost all that money. And she said, no, Susie, as a matter of fact, I was protected because the annuity had a beneficiary arrangement with a guaranteed income benefit, and my income actually went up when my husband passed away. It didn't drop into the abyss, so I didn't lose any money. Susie Orman immediately breaks to intermission, comes back, and the lady's gone.
Oh, of course.
She didn't want to talk about it. And so what I always tell people is, look, investments are designed for specific reasons, and you need to meet your specific needs. That's the problem, because advisors can tend to push a product into a need that you may not have or you may have. And that's where you have to have a little common sense and say, what am I buying this for? What is the purpose of this investment? And is it an investment? An annuity is not an investment. It's a guaranteed income benefit that protects you for lifetime income. In this case, it protected the widow from market decline. She didn't lose any income that she had to have income to raise her and the children. She had to have that income benefit, and everything else was immaterial. She needed that monthly income, and that annuity protected that. That's what annuities do. They're not an investment. Okay?
I thought that was important to bring up because I do remember bringing home a video from the library. I was kind of curious, why was she having all this big buzz about investment and so forth, and I'm watching this realizing, this information is so basic, it just got ridiculous after a while, and I thought, I think the reality is that she's nothing more than a salesperson that's really trying to get you to buy her programs. That's how she makes her wealth.
That's exactly right. I mean,
she's not really an investor. She's just a pundit on the stage, and no criticism to her. She does a great job doing it, but the fact is, she's becoming wealthy by you buying her programs and not investing money. I don't know what the reality is, but it seemed that way anyway.
Well, it's very easy to target other investments that you don't fully understand. And one of the problems with her is that she doesn't understand that the annuity is designed for a specific need. She just sees it as a wholesale product, which it is wholesaled a lot to people that shouldn't be buying it. But for the person who needs it,
right,
it's all the difference in the world. It's like your seatbelt. Your seatbelt is in the car, but boy, if you have a wreck and it saves your life, man, was that ever a valuable thing to have in your car?
You better believe it. Now, number 6 was all advisors are the same, and it seems to me that we just kind of covered that.
Yeah, and that's just patently false, and I tell in there Chapter 14 how to hire and how to interview your advisor.
Mm-hmm. Now, as we also discussed on number 7, demographics mean nothing when it comes to investing. Well, we certainly covered that as well. Demographics sound like they mean quite a bit.
Absolutely. If you don't understand where we've been and where we're going in population, you have no clue what to invest in.
Mm-hmm. Now, number 8, it's not timing the market, but time in the market.
Yeah, and what I talk about here is that I feel that our market, our stock market, our American stock market, in the 1990s became a world market, not an American market. Up until the 80 years before, pretty much our companies that we had in America were American companies. They worked in America, they grew, and they were volatile based on our market conditions. The S&P 500, for example, right now, is really more volatile to the international market than it is to the American stock market. And when we see the volatility in the S&P 500 and the Dow, we're not seeing the volatility because I guarantee you go back 80 years before, you did not see the volatility you've seen since the turn of the century. And in fact, the real rate of return on the S&P 500 for the first 13 years of this new century was less than 3%. Mm-hmm. The 80 years before, it was 10.
Wow.
Now, if that doesn't get your attention, nothing will. And I put a graph in there, and I clearly show it. And if you're not aware of this, and here's the problem: that nobody talks about it on TV. Nobody talks about it because they don't want to talk about it because they want you throwing your money into the market because their advertisers are paying them to get people to participate in the market. Mm-hmm. So you got kind of a whole thing there, but you need to look at the facts. You need to look at the real numbers, and that's one of the things that I think people. And I'll get to number 10 because that's probably the most important one that most people don't get.
Okay. Now, number 9, though, is low fees mean better results.
Yeah, that's emphatically untrue. And one of the things right now that the government's trying to do is they're trying to regulate the fees on 401ks. What they ought to be doing is regulating the rates of return on 401ks. Because I can tell you, and here's an example, if you paid me 1%, but I just didn't make you any money at all, you've got a cheap fee, and you paid that cheap fee to make 1%. Mm-hmm. Okay? Or I charged you 3%, but I made you net 8%. In other words, you got your 3% back plus you netted 8%. Right. Which one would you buy?
Seems to me the second one would be the best way to go.
Yeah, but the fee is 3 times higher.
Yeah, but you're getting that fee back plus 8%.
That's correct. And see, what I tell people is, look, it's not what you gross in an investment. It's what you net.
Right.
And that's hard. I mean, I've had people who are very wealthy who when you sit down with them, you go over fees and stuff and expenses, and when you explain to them, you know, in some of those variable annuities, they're paying as high as 4%, and you tell them that, and they say, yeah, but I don't see it. It doesn't show me. And you say, yeah, but that's why your return sucks. Because it's there, you're just not seeing it. And then I'm showing them a fee that's given them a, you know, I'll give you an example. One of our companies that charges a fee of 2.2% has had a net return of over 8% for 20 years. And you look at that and you say, wait a minute, but that's 2.2. And they say, but I'm only paying, you know, I'm not paying anything in this new. Yeah, but you're not making anything.
Right.
So you want to keep paying nothing so you make nothing.
Mm-hmm.
That doesn't make sense to me. Why wouldn't you go to something that's tried and true and has a strategy and has made money in good and bad times, not had a losing year, and yeah, you're paying a fee, but you're getting something back for it. This is the thing. Don't be a fool. Don't pay for something you're not getting something back for. But if you're seeing something you can get a return back on your money, then it's worth paying that money to get the return.
Mm-hmm.
But you got to get the return, and that's where allowing the strategy to go through a long period of time to see it work, and to see it go through good and bad markets. You got to let the strategy work out, and that's where people lose money because they don't have the patience to stay in there and say, well, I'm going to get out of this investment. Mm-hmm. But low fees. And right now, the big fight on the 401k is about low fees, low fees, low fees. That's ridiculous. We have a managed portfolio in 401k plans that never lost a dime in 2008 when the market crashed. None of the clients in that portfolio lost any money, but the fee is 1%, and most other fees are 20%, 20 basis points. So it's 4 times higher. But the person paying the 20% lost almost 50% and took 5 years to get back to where they were. But the 1% is higher. Why would I pay a 1% fee? Well, you pay a 1% fee because you don't get that big dip, and you made money all 5 years when everybody else was playing catch-up. That's why.
Mm-hmm. And by the way, just to let the listeners know, the word sucks that was mentioned earlier is actually an industry term, so just be aware of that.
The what word?
Sucks.
Sex.
Well, you had said earlier, well, that sucks, and I'm just letting them know that's an actual industry term. So,
oh.
Now, number 10, it's a big one. Your average annual rate of return measures how much you have made on your investment for a period of time.
Yep, and that is the biggest misconception, and it's something that I'm trying to get changed at the federal level because they put that in after the Great Depression. And it was a way to figure out what your return was. And let me just give you simple math. You have $100. You lose 20% the first year. Now so you lose 20% of 100, which is 20. Now you only have $80 left, right? So at the end of 1 year, you're negative 20%. The second year, you make 25% on that 80, which is how much? It's $20. Mm-hmm. So now, at the end of 2 years, you started with 100, you're back to 100. What's your average annual return?
Right now would be 0, wouldn't it?
Well, no, that's your real rate of return.
Okay.
Your average annual return, according to the FINRA and the SEC and the regulators who require that you return rate of return, you made 25, you lost 20, so 25 minus 20 is 5.
Okay.
You divide it by 2, it's you made 2.5% a year. But how could you? You still have the same amount you started with. I just proved to you that average annual return is a lie. Okay. It's a misrepresentation. And we've been doing that for, almost 100 years on our investments, showing a fake number. I've been fighting with companies for years on this, saying, this number isn't real. Because I look at my own and I say, hey, the numbers aren't right. And they say, shut up, don't rock the boat.
Yeah.
Well, it's crazy because we're not telling the public what they're really making. Mm-hmm. And I have shown numerous people where they come in, they have a mutual fund, for example, that they say, gee, I made 10% on this over the last 10 years because that's what the company said. And then I plug in the numbers and I calculated out what they really made, and they made less than 6. And they say, well, I don't like this, Chuck, because I came in here thinking I made 10, but I only made 6. And I say, do you want as Jack Nicholson says, you can't handle the truth. A lot of people can't handle the truth. They get kind of upset and say, well, I don't like that because I like thinking. I said, you like thinking you made 10 when you really made 6?
Right.
I mean, that's not reality.
Mm-hmm.
So that's part of my job that I have to do.
And it's interesting you bring that up, what that is inside each of us, and we all have this. And there was a really fascinating experiment where a person pulled out a $10 bill in front of a group of 5 people. And the idea was to auction this $10 off to the highest bidder. Now imagine that. You're auctioning $10 off, okay?
Yep.
They found people were willing, and this actually happened in this experiment, were willing to pay upwards of $25 to win that $10 bill.
Well,
it's pretty interesting how that instinct inside of us kicks in to make very unreasonable decisions.
Well, and this is not to say that people are stupid, but Ron White, the comedian, has a famous saying, and that is, you can't fix stupid. and some people, I always tell people, look, you have to think with your logic head, not your emotional head.
Right.
And if you could think logically, you could decipher out 99% of everything you need to know through your own cognitive thinking of what you're doing. And that's where people get hung up. They get emotionally, and they see, oh, hey, that guy bid at $10. I'm going to bid 20.
Right.
It's crazy.
Well, even Gordon Gekko in the movie Wall Street said, never get emotional about stock. It clouds the judgment.
and you know what? That was the one part in there that he was exactly right about.
Exactly.
Yeah.
For those of you joining us, our guest today, Chuck Price, joining us here on the program, talking about Investing Simplified, how you can get started to get that financial education that you should have so you can make better decisions when it comes to your money. For our listeners, Chuck, could you give out a website people can also find out more and how they can go about getting the book?
Sure. They can go to our website at pfgwm.com. The book is also available at Amazon Books and is also available on Kindle and soon to be on Apple as well. We just got on Apple because they have to actually read every book to get on there. So they have to read it. Once they read it, and our book's only been out since the middle of November, so they have to read it, but they just approved it, so it'll be on there too as well. And it's going to be available at about 25,000 retailers, but probably not on the shelf. You can order it through their computer system. But the quickest way would be to get it on Amazon.
Well, very good. Well, Chuck, thank you so much for joining us here on the program. I love to help enlighten our listeners out there, to kind of get rid of the muck, get some clarity in there, and start stepping forward because, as we both agreed earlier in the program, investing isn't as complicated as those people out there would make you believe.
Yeah, it really is. And if you simplify everything, you'll be a lot better off.
Well, thank you so much again for joining us here on the program today.
You bet. Have a good day.
We want to thank you, the listeners out there, for tuning in. Get clarity and take those next best logical steps. One step you can also take is visit us at beyond50radio.com. That is the number 50, and you can sign up for our free exclusive e-newsletter. I'm Daniel Davis. Thank you for tuning in. This is the Beyond 50 radio program, and remember, live your day past halfway.